There is a signal, a whisper in the marketplace that most investors are trained to ignore. It doesn't appear in a quarterly earnings report, nor is it charted on a stock ticker. It is a qualitative frequency, a hum of human satisfaction or a screech of collective frustration that emanates not from Wall Street, but from Main Street. This signal, more than almost any other, predicts the long-term trajectory of a business, separating the spectacular, decades-long triumphs from the smoldering wrecks of corporate mediocrity. It is the sound of a company's relationship with its customers. Warren Buffett, the master of long-term investing, learned early in his career that while the numbers tell you where a company has been, the way it treats its people tells you where it is going. He understood that a business that creates fanatics is building a fortress around its future profits, an economic moat deeper and wider than any patent or regulatory advantage. Conversely, a business that treats its customers with contempt is planting the seeds of its own destruction, no matter how dominant it may seem today. This is the final promise of a truly great business, not to its shareholders in the next quarter, but to its customers for a lifetime. To understand this principle is to gain a profound and lasting edge, a way to sidestep the costly market mistakes that trap the 99% and to align your capital with the most powerful force in commerce, genuine human loyalty. Today, we will deconstruct this core tenet of the Warren Buffett strategy, transforming your approach to stock analysis from a simple accounting exercise into a deep investigation of a company's character. You will learn to see what he sees, to hear what he hears, and to invest in the quiet, unstoppable power of a happy customer. Our journey begins with the most critical concept in Buffett's arsenal, the very foundation of his wealth management philosophy, the economic moat. This is the idea that the best businesses possess a durable competitive advantage that protects them from competitors, much like a moat protects a castle. And perhaps the most powerful, most enduring moat of all is the one built not from patents or scale, but from pure, unadulterated customer love. It is a moat of fanaticism. To understand its construction, we must travel back to 1972, to a decision that would forever change how Buffett thought about value. The company was See's Candies, a quaint, family-owned chocolate maker based in California. At the time, Buffett and his partner, Charlie Munger, were looking for high-quality businesses to add to the Berkshire Hathaway portfolio. Munger, with his characteristic intellectual rigor, brought See's to Buffett's attention. The company was a regional icon, known for its black-and-white checkered stores and its impeccably fresh, high-quality chocolates. The See family wanted to sell, and the asking price was $25 million. For Buffett, a student of Benjamin Graham's School of Deep Value Investing, this price was a sticking point. Graham's method was quantitative, focused on buying mediocre businesses at dirt-cheap prices, looking for cigar butts on the ground with one good puff left in them. See's Candies was no cigar butt, it was a gem, and its price reflected that. The company had about $8 million in tangible assets. The $25 million price tag meant they would be paying a massive premium, a $17 million chunk of goodwill. To the Graham-trained Buffett, this was heresy. Paying for an intangible like a brand name felt speculative, a departure from the margin of safety he held so dear. He was ready to walk away, but Charlie Munger persisted. He argued that Buffett was thinking too small, that he was anchored to his old methods. Munger saw something in See's that didn't appear on the balance sheet. He saw the lines out the door during Christmas and Valentine's Day. He saw the generations of families for whom a box of See's was not just candy, but a tradition, an integral part of life's celebrations. He saw a brand that was so beloved, so ingrained in the cultural fabric of its customers, that it had immense pricing power. He posed a simple question to Buffett: how many people, when buying a box of chocolates for their sweetheart, would opt for a generic brand just to save $1 or $2? The answer, he knew, was almost none. The emotional significance of the gift far outweighed the marginal cost difference. The customer wasn't just buying chocolate. They were buying certainty, nostalgia, and the guaranteed smile on their loved one's face. This was a business that had a direct emotional connection to its customer base, and that connection was a fortress. Buffett, to his immense credit, was willing to be convinced. He investigated further, not just the numbers, but the phenomenon. He saw that customers didn't just like See's, they were fanatical about it. They would drive past a dozen other stores to get to a See's. They would happily pay a little more each year for the same box of nuts and chews. This wasn't a commodity business. It was a luxury good disguised as a simple confectioner. The loyalty was so intense that the company could raise its prices by 10% every year, and nobody would bat an eye. The cost of raw materials like sugar and cocoa would go up, they'd pass it on, and sales would continue to climb. This was the economic moat Munger had seen. It was invisible, intangible, but more real and more valuable than any factory or piece of equipment listed on the books. Buffett overcame his initial hesitation, and Berkshire Hathaway bought See's Candies for $25 million. It was a pivotal moment in his career, the transition from being a pure cigar-butt value investor to a buyer of wonderful businesses at fair prices. And the results have been nothing short of staggering. Since 1972, See's Candies has generated over $2 billion in pre-tax earnings for Berkshire, a return of 80-fold on their initial investment. And it has done so while requiring very little additional capital. The profits flowed out of See's and were used by Buffett to acquire other great businesses. See's Candies became the prototype, the foundational lesson in the power of brand equity built upon decades of exceptional customer experience. It taught Buffett that the most valuable asset a company can have is a corner of the customer's mind, a small piece of their heart, that is reserved exclusively for them. This creates a moat of fanaticism that competitors, no matter how much capital they have, simply cannot cross. The incredible loyalty that See's Candies commands isn't an accident of marketing. It is a predictable outcome of deep-seated psychological principles. The human brain is not a perfectly rational calculator. It is a storytelling machine that operates on emotion, habit, and mental shortcuts. A business that understands this can build a competitive advantage that is nearly impossible to replicate. One of the core principles at play is the mere exposure effect. This is our subconscious tendency to develop a preference for things simply because we are familiar with them. Every visit to a clean, friendly See's store, every positive experience with their product, every holiday that features their iconic box, reinforces a positive association in the customer's brain. It becomes the default, the comfortable, the right choice. The brain prefers the known path over the unknown because it's less cognitively demanding. Choosing a different brand of chocolate requires effort, risk, and the potential for disappointment. Choosing See's is easy, safe, and emotionally rewarding. This effect is amplified by another powerful force: social proof. Humans are herd animals. We look to the actions and behaviors of others to determine our own. When we see a long line snaking out the door of a See's store in December, our brain doesn't think, "What an inconvenience." It thinks, "This place must be amazing. All these people can't be wrong." This collective endorsement validates our own choice and strengthens our conviction. It turns a personal preference into a shared cultural experience. You aren't just a person buying candy. You are part of a tribe, a community of people with good taste who appreciate quality. This sense of belonging is a powerful emotional driver that transcends the simple transaction of goods for money. Furthermore, this fanaticism is cemented by what psychologists call commitment and consistency. Once we have publicly identified ourselves as a See's person, our brain works to protect that identity. To switch to another brand would create a small amount of cognitive dissonance, an uncomfortable feeling that arises from holding two conflicting beliefs. I am a loyal See's customer, and I am buying this other, cheaper brand. To avoid this discomfort, we remain consistent with our past behavior. We rationalize our loyalty, telling ourselves and others stories about the superior quality, the tradition, the memories associated with the brand. We become unpaid evangelists, defending our choice and recruiting others into the fold. A company that cultivates this dynamic is no longer just selling a product. It is curating an identity for its customers. The purchase is a reaffirmation of who they are. This is why pricing power is the ultimate test. A rational consumer might switch brands over a 10% price increase. But an emotionally invested, identity-aligned fanatic will not. The cost of switching isn't measured in dollars. It's measured in the emotional discomfort of betraying their tribe and their own self-concept. Understanding this psychological architecture is essential for any retail investor looking to perform a truly deep stock analysis. It allows you to see beyond the superficial marketing and identify businesses that are methodically building an army of loyalists, one positive interaction at a time. This is the qualitative analysis that separates a good investment from a truly legendary one. So how can you, as an entrepreneur or a retail investor, translate this powerful concept into a practical tool for stock picking and wealth management? The answer is to create a systematic mental model, a blueprint for identifying these fanatical customer bases. Let's call it the fanaticism test. It's a 5-step process of qualitative analysis that goes beyond the spreadsheet and into the real world. Step 1. Become the customer. This is the most crucial and most overlooked step in modern stock analysis. If you are analyzing a restaurant chain, go eat there, not once but multiple times at different locations. If it's a retailer, buy their product online and in-store. Document the entire experience. Was the website intuitive? Was the store clean and the staff helpful? Was the product high quality? Was the return process easy? You must experience the company from the customer's perspective to understand its true nature. Buffett does this constantly. He drinks Coke, eats at Dairy Queen, and wears Fruit of the Loom. This isn't just a folksy affectation, it's primary research. Step 2. Become a digital anthropologist. Dive deep into the unvarnished corners of the internet where real customers talk. Scour Reddit subreddits, dedicated fan forums, and social media comments. Ignore the polished testimonials on the company's website. You are looking for unsolicited praise. Pay close attention to the language people use. Is it purely transactional? The shipping was fast. Or is it emotional? I can't imagine celebrating a birthday without their cake. Look for stories, for people sharing memories connected to the brand. This is the raw data of brand equity. Step 3. Apply the tattoo test. This is a simple but powerful heuristic. Ask yourself, is this a brand that someone, somewhere, would be willing to tattoo on their body? Think of Harley-Davidson, Apple, or Disney. While very few companies reach this level of devotion, the question itself forces you to evaluate the intensity of the customer relationship. Does the brand have a soul? Does it stand for something more than just its product? A company that passes this test, even hypothetically, has a level of customer connection that is a powerful economic moat. Step 4. Systematically assess pricing power. This is where the qualitative meets the quantitative. Look at the company's history of price increases relative to its competitors and inflation. Have they been able to consistently raise prices without losing market share? Imagine they announced a 10% price hike tomorrow. Go back to those fan forums and ask yourself, would the reaction be outrage and defection, or would it be grumbling followed by reluctant acceptance? A business that can consistently pass on costs and then some to its customers owns a piece of their mind. And that ownership is one of the most valuable assets in the world of long-term investing. Step 5. Talk to the front lines. If possible and appropriate, talk to the company's employees, especially those who interact with customers every day. Ask them what the most common customer complaints are, and more importantly, what the most common compliments are. Ask them if they feel empowered to make things right for a customer. Their answers will give you a direct insight into the company's culture and its true commitment to customer satisfaction. By following this 5-step blueprint, you move beyond the role of a passive retail investor and become an active business analyst. You are building a mosaic of understanding, gathering data points that will never appear in a financial filing but are powerful predictors of future portfolio growth. The path of the 99% of investors is paved with a dangerous and seductive fallacy, the belief that what is cheapest is best. This thinking creates the commodity trap, a race to the bottom that destroys both businesses and portfolios. Most investors, when conducting a stock analysis, will screen for low price-to-earnings ratios or low price-to-book values. They are hunting for bargains in a purely numerical sense. Similarly, most entrepreneurs and corporate managers are obsessed with cost-cutting. They see customer service departments not as profit centers, but as cost centers to be minimized. They squeeze their suppliers, reduce the quality of their raw materials, and underpay their employees, all in the name of shaving a few pennies off the cost of goods sold to offer a slightly lower price than their competitor. This is the antithesis of the Buffett strategy. It is a short-term game that guarantees long-term failure. A company that competes solely on price has no moat, it has no loyalty. Its customers are mercenaries, ready to defect the moment a competitor offers a slightly better deal. This creates a brutal, relentless cycle of margin erosion. To maintain market share, the company must constantly lower its prices, which means it must constantly cut more costs, which inevitably leads to a decline in product quality and customer service. The customer experience becomes transactional, impersonal, and often frustrating. Think of the faceless, generic store brands that occupy the bottom shelf of the grocery aisle. They have no story, no emotional connection, no tribe. Their only selling proposition is their price. They might win a sale today, but they have not won a customer for tomorrow. An investor who buys into this type of business is buying into a perpetual struggle for survival. The company has no pricing power, which means it is completely at the mercy of inflation and input costs. It cannot generate the high returns on capital that characterize a truly wonderful business like See's Candies. The 99% of investors fall into this trap because it's easy. Comparing prices is simple. Reading a balance sheet is straightforward. Understanding the complex emotional architecture of customer loyalty is hard. It requires qualitative analysis, legwork, and a degree of empathy that is often discouraged in the cold, rational world of finance. They mistake the tangible assets they can count for the only assets that count. They fail to see that a business with fanatical customers has a hidden reservoir of goodwill that allows it to weather storms, raise prices, and compound its value for decades. The path of the 99% is to buy the statistically cheap company with unhappy customers and hope for a turnaround. The path of the truly savvy investor is to buy the wonderful business with a fanatical following at a fair price and enjoy the ride. The former is a stressful gamble. The latter is a predictable and profitable journey in long-term investing. The financial connection between customer fanaticism and a company's performance is not theoretical. It is a direct, quantifiable, and explosive force that manifests on every line of the financial statements. Understanding this connection is the key to unlocking true portfolio growth. First and most obviously is the impact on the top line, revenue. A fanatical customer base leads to highly predictable, recurring revenue streams. These are not one-time buyers. They are subscribers to the brand, whether or not a formal subscription exists. This creates a stable and growing revenue base that is less susceptible to the whims of the economic cycle. More importantly, this loyalty is the engine of pricing power. Let's quantify the See's Candies example. If a company can raise its prices by just 5% a year without losing customers, its revenue will double in about 14 years from pricing alone, even with zero growth in volume. When you add in volume growth from an expanding fan base, the effect is exponential. This pricing power flows directly to the gross margin line, creating a much more profitable business. Second, consider the impact on expenses. A business with a cult-like following has dramatically lower customer acquisition costs. Its best salespeople are its existing customers, who spread the word for free. This viral organic growth means the company doesn't need to spend billions on advertising to convince people to try its product. This efficiency is a massive competitive advantage. Compare the marketing budget of a beloved brand to that of a commodity business that must constantly scream for attention. That difference is pure profit. Furthermore, employee turnover is often lower in companies with happy customers. People want to work for a company they are proud of, a company that is admired. Lower turnover means lower recruitment and training costs, which again flows directly to the bottom line. Third, and most powerfully, is the impact on the balance sheet and capital allocation. The See's Candy story is the ultimate example. Because the brand itself is the primary asset, the business requires very little incremental capital to grow. It is, as Buffett calls it, a quote, capital-light business. It doesn't need to build massive new factories or invest heavily in research and development. The profits it generates are free and clear to be distributed to the owners. In Berkshire's case, the $2 billion in pre-tax profit from See's was not reinvested into the candy business. It was deployed by Buffett to buy other wonderful companies. This is the magic of a high return on invested capital (ROIC) business. It becomes a cash geyser that fuels the growth of the entire enterprise. When you, as a retail investor, buy a share of a company like this, you are buying a piece of this incredibly efficient financial machine. The brand equity, the customer fanaticism, is an unseen asset that is worth far more than all the tangible assets combined. It is the engine of a compounding machine that, over a lifetime of long-term investing, can turn a modest investment into a fortune. This is the direct financial connection that the Warren Buffett strategy seeks to exploit, a connection that is hidden in plain sight, waiting for those who know how to look beyond the numbers and see the business for what it truly is, a relationship between a company and its people. A company's relationship with its customers is its greatest asset, but in the world of traditional finance, it's an asset that doesn't officially exist. There is no line item on a balance sheet for customer trust or brand loyalty. These immensely valuable concepts are bundled into an opaque and often misleading category called goodwill. This leads us to our second pillar. Understanding that customer satisfaction is a very real, though unseen asset that drives future cash flows, and learning to identify it is a powerful tool for any value investing practitioner. The most dramatic illustration of this principle in Warren Buffett's career occurred in the fall of 1963. A moment of crisis that would define his reputation as a brilliant contrarian. The company was American Express, a titan of the financial world known for its iconic charge cards and traveler's checks. The crisis became known as the Salad Oil Scandal. A New Jersey-based company run by a man named Tino DeAngelis had taken out massive loans from various banks, with the loans secured by his inventory of salad oil, which was stored in large tanks. American Express, through a subsidiary, was in the business of warehousing and inspecting such inventories, issuing receipts that certified the existence of the collateral. These receipts were then used by companies like DeAngelis's to get their loans. The problem was, Tino DeAngelis was a fraud. His tanks were mostly filled with seawater, with only a thin layer of salad oil floating on top to deceive the inspectors. When the fraud was discovered, his company collapsed, and it became clear that the millions of dollars in loans he had taken out were worthless. The banks that had lent him the money were facing catastrophic losses, and they turned to the one entity they could hold responsible, American Express, whose subsidiary had certified the collateral. Wall Street panicked. The potential liabilities for American Express were enormous, estimated to be over $175 million. A sum that could easily bankrupt the company. The stock price was obliterated, plummeting by more than 50% in a matter of weeks. The consensus view was that American Express was finished. The narrative was one of incompetence and ruin. But Warren Buffett, then a young, relatively unknown hedge fund manager in Omaha, saw a different story. He didn't just look at the potential liabilities on the balance sheet. He decided to investigate the company's real asset, the one that was completely invisible to the frantic sellers on Wall Street. He got up from his desk and started doing on-the-ground research, a hallmark of his qualitative analysis approach. He went to restaurants. He went to banks. He visited travel agencies. He talked to merchants and customers. And everywhere he went, he asked the same simple questions. Are you still accepting American Express cards? Are people still buying your traveler's checks? The answer, overwhelmingly, was yes. He observed that despite the screaming headlines about the salad oil scandal, the average person's perception of American Express had not changed. They still saw the iconic blue card as a symbol of prestige and security. They still trusted the traveler's checks as being as good as cash, anywhere in the world. The scandal was a remote, complicated financial story that had no bearing on their personal experience with the brand. Buffett realized that the market was making a classic mistake. It was confusing a problem in one small subsidiary with a mortal wound to the entire enterprise. The true business of American Express was not warehousing salad oil, it was the business of trust. And that trust, cultivated over decades of reliable service, was a colossal asset that was completely intact. This unseen asset of brand equity was far more valuable than the potential liabilities from the scandal. While other investors were staring at the balance sheet in terror, Buffett was observing human behavior in the real world. He concluded that the company's core earnings power was undamaged, so he acted with conviction. He invested 40% of his partnership's entire capital into American Express stock, buying it at a fraction of its former price. It was the single largest investment he had ever made. Over the next few years, as American Express dealt with the financial fallout of the scandal and its core business continued to thrive, the stock price soared. Buffett's partnership made a fortune. The salad oil scandal became a legendary case study in value investing, a powerful lesson that a company's relationship with its customers can be its most valuable asset, especially when it is being ignored by a panicked market. It proved that a deep understanding of customer satisfaction is not a soft skill. It is a hard-edged tool for achieving spectacular portfolio growth. The reason Warren Buffett's American Express investment was so successful lies in the predictable and often irrational workings of the human mind. The market panicked because it was reacting to new, scary information. But American Express customers did not panic because their behavior was governed by much deeper, more stable psychological forces. One of the most potent of these is the principle of commitment and consistency, amplified by the power of identity. For a customer in the 1960s, being an American Express card member was not just a way to pay for things, it was a status symbol. It signaled that you were a person of means, a member of a select group. This identity becomes part of your self-concept. When a person's identity is tied to a brand, they are incredibly resistant to negative information about that brand. To accept that American Express was a poorly run or untrustworthy company would be to accept that their own judgment was flawed, that their status symbol was a sham. This creates a state of cognitive dissonance, the mental stress experienced when holding two contradictory beliefs. To resolve this dissonance, the brain will do everything it can to protect the existing belief. Customers would have subconsciously rationalized the situation, telling themselves things like, "It was just one small part of the company," or "The core service I use is still excellent," or "All big companies have problems sometimes." This powerful drive for internal consistency meant that the customer's behavior remained unchanged. They continued to use their cards and buy travelers' checks because to do otherwise would be to challenge their own identity. Buffett didn't need a degree in psychology to understand this. He simply observed it. He saw that the social contract between the company and its customers was stronger than the financial panic on Wall Street. Another related principle is the affect heuristic, which is a mental shortcut that allows people to make decisions and solve problems quickly and efficiently, in which current emotions, fear, pleasure, surprise, etc., influence decisions. For years, American Express had been building up a reservoir of positive affect or good feelings with its customers. Every successful trip paid for with travelers' checks, every seamless transaction at a restaurant, was a small deposit into this emotional bank account. The salad oil scandal was a large withdrawal, but for the average customer, the account was still massively in the positive. Their overall feeling about the brand was still one of trust and security. and this feeling guided their behavior far more than a rational analysis of the headlines. Wall Street, on the other hand, was driven by a different emotion: fear. The affect heuristic was working in the opposite direction. The fear of catastrophic loss led to a cascade of selling, a herd mentality that ignored the underlying stability of the brand's relationship with its core constituency. By understanding these competing psychological currents, Buffett was able to make a rational decision while everyone else was behaving irrationally. He saw that the foundation of the business, the psychological attachment of its customers, was solid. This is a critical lesson for any retail investor. Markets are driven by emotion in the short term, but long-term value is created by the enduring, identity-driven loyalty of customers. Learning to analyze that loyalty provides a powerful anchor in the stormy seas of market volatility, a key principle of any successful Warren Buffett strategy. To apply this lesson to your own stock picking, you need a mental model for evaluating this unseen asset of trust. You need a way to look beyond the goodwill line item on the balance sheet and conduct a genuine audit of a company's relationship with its customers. Let's call this blueprint the trust ledger analysis. It's a 4-step process for making the intangible tangible. Step 1. Document the trust deposits. For any company you are analyzing, your first task is to create a comprehensive list of all the ways it builds trust with its stakeholders. A trust deposit is any action the company takes that fulfills or exceeds a promise. This could be a product that lasts longer than expected, a customer service interaction that solves a problem with surprising efficiency and empathy, an incredibly generous return policy, or radical transparency in its marketing and communications. Think of companies known for their no-questions-asked warranties, or their fanatical customer support. Each of these instances is a deposit into the brand's trust account. Your job as an analyst is to find evidence of these deposits, looking through customer reviews, social media, and product forums. Step 2. Document the trust withdrawals. Next, you must catalog all the ways the company has broken trust. A trust withdrawal is a failed promise. This could be a product that breaks prematurely, a data breach that exposes customer information, misleading advertising, a difficult cancellation process, or customer service that is dismissive and unhelpful. Scandals like the one at Wells Fargo, where employees created fake accounts, are massive, catastrophic withdrawals. But you should also look for the smaller, more insidious patterns of trust erosion. A company that constantly uses fine print to trap customers in subscriptions is making small but steady withdrawals that will eventually empty the account. Sources for this information include Better Business Bureau complaints, regulatory filings, and, again, the unfiltered voice of customers online. Step 3. Analyze the net balance and the crisis response. Once you have your ledger of deposits and withdrawals, you can assess the net balance. Is this a company that is consistently building trust, or is it slowly eroding its most valuable asset? More importantly, you must analyze how the company responds when it makes a significant withdrawal. How does it handle a crisis? Does it take ownership, communicate transparently, and make amends, a trust deposit? Or does it deny, deflect, and blame the customer, another trust withdrawal? A company's character is never more visible than in its response to failure. A company that uses a crisis as an opportunity to reinforce its commitment to its customers is one that understands the value of this unseen asset. Step 4. Compare the trust ledger to the financial goodwill. Finally, look at the goodwill figure on the company's balance sheet. This number primarily represents the premium paid for acquisitions over the book value of the assets acquired. Ask yourself, does this accounting figure bear any resemblance to the real-world brand equity and customer trust you have just documented? Often you will find a massive discrepancy. A company might have a huge amount of goodwill on its books from a series of ill-advised acquisitions, yet its trust ledger is deeply in the red. Conversely, a company that has grown organically by delighting customers for decades, like See's Candies before its acquisition, might have zero goodwill on its balance sheet but a trust ledger that is overflowing. This gap between accounting fiction and relational reality is where incredible investment opportunities are found. By performing this trust ledger analysis, You are doing the hard work of qualitative analysis that most investors skip. You are measuring the unmeasurable and seeing the true value of a business, a skill that is fundamental to successful long-term investing and wealth management. The path of the 99% is to be a spreadsheet-only investor. This investor lives in a two-dimensional world of numbers, ratios, and historical data. They build complex financial models, screen for dozens of quantitative metrics, and believe that the entirety of a business can be understood through its financial statements. When the salad oil scandal hit, the spreadsheet-only investor saw only one thing: a massive, unquantifiable liability. Their models flashed red. Their debt-to-equity ratio calculations went haywire. The potential for a complete wipeout of shareholder equity was a real, calculable risk. Their decision-making process was simple and logical. The risk is too high, the numbers are too scary, sell immediately. They acted in their minds with perfect rationality, but they were blind to the most important asset the company possessed because it couldn't be entered into a cell in their spreadsheet. They had no way to quantify the fierce loyalty of a card member, the implicit trust a merchant placed in the American Express logo, or the global recognition of the traveler's check. These were soft, fuzzy, qualitative factors that had no place in their rigorous quantitative world. They failed to see that the business was not its balance sheet. The business was its brand. The 99% of investors fall into this trap because the world of finance trains them to. Business schools teach discounted cash flow analysis, not how to gauge customer sentiment. Wall Street rewards analysts who can build complex models, not those who spend their time talking to customers. The entire ecosystem of modern finance is built around the tangible, the measurable, and the historical. As a result, the market is systematically inefficient at pricing intangible assets like trust and brand equity. The spreadsheet-only investor confuses precision with accuracy. Their model can precisely calculate the impact of a $50 million write-down, but it cannot accurately gauge the value of 1 million delighted customers. This analytical myopia creates incredible opportunities for those willing to do the qualitative work. While the spreadsheet-only investor was selling American Express in a panic, Buffett was doing the opposite of what was easy. He was walking the streets, observing human behavior, and making a judgment about the character and resilience of the company's relationship with its customers. He was buying the unseen asset that the spreadsheet jockeys couldn't even see, let alone value. The costly mistake of the 99% is not a lack of intelligence or a failure of calculation. It is a failure of imagination. It is the inability to see that the most powerful economic forces are often the ones that can't be neatly quantified. For the retail investor looking to achieve extraordinary portfolio growth, the lesson is clear. The spreadsheet is a tool, not a master. It tells you the score of a game that has already been played. To predict the winner of the next game, you must get out of the press box, get down on the field, and understand the players. The direct financial connection between the unseen asset of customer trust and a company's bottom line is profound and multifaceted. It is the invisible engine that drives sustainable, long-term value creation. Let's break down the quantifiable impact. First, customer trust directly lowers the cost of doing business, particularly customer acquisition cost, CAC. A trusted brand doesn't need to shout. It can whisper. Its reputation precedes it, meaning customers come pre-sold, often through word of mouth, which is the most effective and cheapest form of marketing. The money that competitors must pour into advertising just to get a customer in the door can be retained by the trusted company as pure profit, or reinvested to further improve the customer experience, creating a powerful virtuous cycle. A high-trust company simply has to spend less to generate $1 of revenue. Second, trust dramatically increases the lifetime value, LTV, of a customer. A customer who trusts a company is more likely to buy from them repeatedly over many years, to purchase higher-margin products and services, and to be less price-sensitive. They are more forgiving when mistakes happen, and more willing to try new product offerings from the brand. The LTV to CAC ratio is a critical metric for business success. A trusted brand enjoys a naturally high ratio, meaning each customer is incredibly profitable over the long term. This is a formula for exceptional portfolio growth. Third, trust provides a critical buffer during times of crisis. As the American Express salad oil scandal demonstrated, a deep reservoir of trust can act as a shock absorber, allowing a company to survive a potentially fatal blow. The market may panic, but a loyal customer base provides a bedrock of stable, ongoing revenue that gives the company time to solve its problems. This resilience is a form of financial insurance that doesn't appear on the balance sheet but is invaluable. A less trusted company facing a similar crisis would have seen a simultaneous collapse in its stock price and its customer base, a death spiral from which it would be impossible to recover. Finally, this unseen asset translates into a superior return on equity, ROE. Because the asset of trust is built over time through operational excellence, not purchased with debt or equity, it doesn't require a lot of capital. A company with a powerful, trusted brand can often generate enormous profits from a relatively small base of tangible assets. This is the hallmark of a wonderful business in the Warren Buffett strategy. It is a capital-efficient compounding machine. When you see a company with a consistently high ROE, and you can't explain it through traditional assets, the answer often lies in this hidden reservoir of customer trust. By learning to identify and value this asset, you are not just engaging in a soft qualitative analysis, you are finding the very source code of long-term financial outperformance. This is the secret that separates the value investing legends from the crowd of spreadsheet-only analysts. A great reputation built one satisfied customer at a time is like a snowball rolling down a very long hill. It starts small, but with time and consistency, it gathers mass and momentum until it becomes an unstoppable force. This is the compounding power of reputation, our third pillar. It's an idea that explains how certain businesses can grow for decades with seemingly little effort, crushing competitors through the sheer weight of their accumulated goodwill. For the ultimate case study in this phenomenon, we must look to perhaps the most remarkable entrepreneur in the Berkshire Hathaway family, Rose Blumkin, better known as Mrs. B, the founder of the Nebraska Furniture Mart. Her story is the embodiment of how an obsessive focus on customer value can compound into an empire. Mrs. B was a Russian immigrant who fled to the United States in 1917. She arrived in Omaha, Nebraska in 1922, unable to speak a word of English and with no formal education. She was, by all accounts, a force of nature. In 1937, with a $500 loan from her brother, she started the Nebraska Furniture Mart in the basement of her husband's pawn shop. Her business philosophy was brutally simple and ruthlessly executed: sell cheap and tell the truth. This was not a marketing slogan, it was a sacred vow. She was obsessed with getting the absolute lowest prices from her suppliers, haggling with a legendary tenacity, and then passing those savings on to her customers. She operated with razor-thin margins, believing that volume and customer loyalty would more than make up for the low markup. She worked tirelessly, from open to close, 7 days a week, personally managing every aspect of the business. Her reputation for honesty and value began to spread like wildfire across Omaha. Stories of her integrity were legion. If a customer found a piece of furniture for a lower price anywhere else, she would not just match the price, she would give them the item for free. She treated everyone, from the wealthiest farmer to the poorest laborer, with the same respect and commitment to value. Over the years, this reputation compounded. Word of mouth was her only form of advertising. A satisfied customer would tell their friends and family, and they in turn would become lifelong patrons. Generations of Nebraskans grew up knowing that if you needed furniture, you went to Mrs. B's. It was the only rational choice. By the 1980s, her small basement operation had grown into the single largest home furnishing store in the United States. A sprawling campus in Omaha that generated hundreds of millions of dollars in annual sales. This is when Warren Buffett entered the picture. In 1983, Buffett, a longtime admirer of Mrs. B's business acumen, decided he wanted to buy the Nebraska Furniture Mart for Berkshire Hathaway. He went to see the then 90-year-old Mrs. B and made her an offer. He famously bought 90% of the company for $60 million based on a simple, one-page agreement and a handshake. He did not perform an audit of the books. He did not bring in a team of lawyers or investment bankers. He said later, "We gave Mrs. B a check for $60 million and she gave us her word. That's all we needed." He wasn't buying inventory or buildings. He was buying the single greatest asset the company possessed, its unblemished 50-year-old reputation for honesty and value. He knew that this reputation was an economic moat that no competitor could ever hope to breach. The story doesn't even end there. A few years later, after a dispute with her grandsons who were then running the business, a 96-year-old Mrs. B quit in a huff and opened a rival store right across the street, called Mrs. B's Clearance and Factory Outlet. It immediately became a massive success, stealing business from the very store she had sold to Buffett. She was literally competing with Berkshire Hathaway and winning. After a few years, a bemused Buffett had no choice but to buy her out again, acquiring her new store and agreeing to a non-compete clause, probably the only one in history signed by a woman approaching her 100th birthday. The story of Mrs. B and the Nebraska Furniture Mart is the ultimate testament to the compounding power of reputation. It shows that a business built on a foundation of genuine customer value can become an invincible fortress, a testament to a long-term investing strategy focused on the intangible but all-powerful asset of a good name. The seemingly magical compounding of the Nebraska Furniture Mart's reputation can be explained by two powerful psychological principles that govern human social interaction: reciprocity and the halo effect. Understanding these is essential for any entrepreneur or investor who wants to replicate this success. Reciprocity is the deeply ingrained social norm of responding to a positive action with another positive action. When Mrs. B gave her customers a genuinely incredible deal, a high-quality piece of furniture at a price they knew was unbeatable, she wasn't just making a sale. She was giving them a gift. This act of generosity triggered a powerful subconscious urge in the customer to reciprocate. For most, this reciprocation didn't take the form of paying more. It took the form of loyalty and evangelism. They felt a social obligation to repay her fairness by returning for all their future furniture needs, and by telling everyone they knew about the incredible store run by the honest old woman. This is why word of mouth was so powerful for her business. It wasn't just a marketing channel, it was a social currency being exchanged. Each recommendation was a small act of reciprocity, a way of paying Mrs. B back for the value she had provided. A business that consistently creates this feeling of positive obligation in its customers builds a self-perpetuating marketing machine that is far more effective and credible than any paid advertising campaign. The second principle at play is the halo effect. This is a cognitive bias where our overall impression of a person, or in this case, a business, influences our feelings and thoughts about their specific traits. Because Mrs. B had established an ironclad reputation for honesty and low prices, customers subconsciously assumed that everything else about the business must also be excellent. This halo of trust extended to all aspects of the operation. They assumed the quality of the furniture was top-notch, the delivery service would be reliable, and the sales staff would be helpful, all because the central pillar of the brand, Mrs. B's personal integrity, was so strong. This halo effect simplifies the decision-making process for the customer. They don't need to research every single aspect of their purchase. They can trust the brand as a whole because of its dominant positive characteristic. This creates incredible operational efficiencies. The business doesn't have to be perfect in every area, as long as it is legendary in the one area that matters most to its customers. For the Nebraska Furniture Mart, that was price and honesty. This halo served as a powerful shield against competitors. Even if a rival offered a slightly better delivery service or a more stylish showroom, it didn't matter. They couldn't compete with the halo of trust that Mrs. B had spent decades building. An investor performing a stock analysis on a company must look for this halo. What is the one thing the company is so good at that it casts a positive light on everything else they do? Identifying this is key to understanding the durability of its competitive advantage and its potential for long-term portfolio growth. To harness the compounding power of reputation for your own investments or your own business, you need a structured way to assess it. This mental model can be called the reputation audit, a three-part process for mapping and understanding this critical, intangible asset. Step 1. Map the company's reputation footprint. A company's reputation doesn't just exist with its customers, it exists in a complex ecosystem of stakeholders. Your audit must examine all of them. Start with employees. Go to websites like Glassdoor and read reviews. Do employees feel proud to work there? Do they feel the company lives up to its values? A company that treats its employees poorly will never be able to sustain a culture of great customer service. Next, investigate its reputation with suppliers. Are they known as a fair partner, or do they squeeze every last penny from their vendors? A company with a bad reputation among suppliers will eventually face issues with quality and reliability. Then, look at its reputation in its local community. Does it contribute positively? Is it seen as a good corporate citizen? Finally, and most importantly, synthesize all your research on its customer reputation. The goal is to create a 360-degree map. A strong reputation across all these domains indicates a healthy, resilient corporate culture that is likely to endure. Step 2. Analyze the word-of-mouth velocity. A good reputation is not a static asset, it is a dynamic one. You need to assess whether it is growing or shrinking. Is the positive sentiment about the company accelerating? You can gauge this by looking at social media trends, the volume and sentiment of online reviews over time, and by asking a simple question: are the company's customers acting as its unpaid sales force? Look for evidence of organic evangelism. Do customers create fan pages, online communities, or user groups dedicated to the product without any prompting from the company? This is a sign of high word-of-mouth velocity. A company whose reputation is actively and rapidly spreading has a powerful growth engine that will not show up in traditional financial analysis. This qualitative analysis is crucial for identifying businesses on the cusp of exponential growth. Step 3. Assess the reputation risk. No moat is invincible, and a good reputation, while durable, can be destroyed. The final step of the audit is to identify the primary risks to the company's good name. Is the reputation tied too closely to a single person, like a founder-CEO? What happens when that person leaves? This was a real risk for Berkshire with Mrs. B. Has the company grown so large that it is losing touch with the core values that built its reputation in the first place? Is there a potential for a scandal related to its products, data security, or corporate culture? And most importantly, what systems and safeguards has the company put in place to protect its reputation? Do they have a clear crisis communication plan? Do they empower employees to solve customer problems on the spot? A company that is not actively managing its reputational risk is like a castle owner who never inspects the walls of his moat. By conducting this three-part reputation audit, you move beyond a superficial understanding of a brand. You are developing a deep, nuanced view of its most valuable asset, a critical skill for any serious practitioner of the Warren Buffett strategy of long-term investing. The antithesis to building a compounding reputation is the seductive and destructive path of growth hacking at all costs. This is the mindset of the 99% of modern startups, and even many established corporations. It is a philosophy that prioritizes short-term measurable gains over the slow, patient work of building long-term trust. The growth hacker lives in a world of metrics: daily active users, conversion rates, customer acquisition costs. Their job is to make these numbers go up and to the right, and they will use any tool at their disposal to do so. This often leads to a series of decisions that, while individually justifiable on a spreadsheet, collectively destroy the company's soul and erode its reputation. They might employ deceptive design patterns or dark patterns on their website to trick users into signing up for subscriptions they don't want, or making it nearly impossible to cancel. This might boost the short-term revenue numbers, but it creates a deep sense of resentment in the customer. They might bombard their users with spammy emails and notifications, sacrificing the long-term relationship for a momentary flicker of engagement. They might cut corners on product quality or customer support to hit a quarterly profit target, believing that customers won't notice or care. The problem with this approach is that it treats customers not as partners to be served, but as resources to be exploited. It views the relationship as purely transactional. This mindset completely misses the power of reciprocity and the halo effect. There is no gift of value being given, so there is no loyalty to be reciprocated. Every negative interaction, every manipulative tactic, is a small withdrawal from the trust account. Over time, these withdrawals compound, creating a reputation for being a company that cannot be trusted. Once this reputation sets in, the business is caught in a trap. It must spend more and more on marketing to replace the customers who are constantly churning out. Its growth becomes a leaky bucket that it must frantically try to fill. The 99th% of investors often fall for these companies, especially in the tech sector. They are seduced by the impressive top-line growth numbers, failing to look deeper at the quality of that growth. They don't see the underlying rot in the customer relationship. They are buying a company that is burning its furniture to heat its house. The fire looks bright and warm for a while, but the long-term outcome is inevitable ruin. This is the fundamental difference between building a business and simply growing one. Mrs. B was building a business for the ages, one brick of trust at a time. The growth hacker is trying to hit a quarterly target. The former creates lasting wealth. The latter, more often than not, creates a temporary illusion that eventually evaporates, taking investor capital with it. A core part of any sound stock-picking methodology must be to differentiate between these two approaches. The financial connection between a compounding reputation and a company's performance is one of the most powerful, yet least appreciated, forces in business. It is the secret fuel behind many of the world's most successful and durable companies. Let's trace the direct path from a good name to a stellar balance sheet. The first and most direct financial benefit is a dramatic reduction in operating expenses. A company with a stellar reputation, like the Nebraska Furniture Mart, can operate with a marketing and advertising budget that is close to zero. Its customers do the marketing for it. This is a massive and permanent cost advantage over its competitors, who must spend a significant percentage of their revenue just to stay relevant. This cost savings can be reinvested into lower prices, which further enhances the reputation, creating a feedback loop that Buffett calls a, quote, virtuous circle. A strong reputation also significantly lowers employee-related costs. The best people want to work for companies that are admired. This means a company with a great reputation can attract and retain top talent without having to pay a premium. Lower employee turnover translates directly into lower recruitment, hiring, and training costs. Furthermore, engaged and proud employees are more productive and provide better customer service, further strengthening the company's reputation and financial performance. Secondly, a compounding reputation allows for better terms throughout the entire supply chain. Suppliers want to do business with highly reputable companies. They may offer better pricing, more favorable payment terms, or prioritized access to the best materials, all of which lower the cost of goods sold and improve gross margins. Lenders also view a reputable company as a lower credit risk, granting it access to cheaper capital. This lower cost of capital is a significant and sustainable financial advantage. Finally, and most importantly, a great reputation creates immense strategic flexibility and resilience. It allows a company to weather economic downturns more effectively, as loyal customers are less likely to defect. It allows them to launch new products with a higher probability of success, as customers are willing to trust the brand's endorsement. And it creates a powerful defense against new competitors. A startup with a massive venture capital war chest may be able to compete on price or features, but it cannot instantly replicate a reputation that has been built over 50 years of consistent, honorable behavior. This is the ultimate economic moat. For the retail investor, this translates into a search for businesses with low and stable operating expenses, consistently high margins, and a durable market position. These are often the financial symptoms of a deep, underlying asset, a compounding reputation. This is the essence of the Warren Buffett strategy: to find these reputational fortresses, buy them at a fair price, and hold them as their financial power continues to compound for decades, driving superior portfolio growth. We have explored how a business can build a fortress of loyalty and a powerful, compounding reputation, but the principle also works in reverse. Customer dissatisfaction is not just a customer service issue. It is a critical leading indicator of deep-seated operational, cultural, and financial problems within a business. It is the canary in the coal mine, signaling impending danger long before the spreadsheets turn red. This brings us to our fourth pillar: recognizing that customer anger is a signal to sell or to stay away entirely. For decades, Warren Buffett famously avoided the entire airline industry, a sector notorious for its dreadful customer service. He often quipped, "If a capitalist had been present at Kitty Hawk back in the early 1900s, he should have shot Orville Wright," lamenting the immense destruction of capital the industry had caused over its history. While his recent investments show a nuanced view on a now consolidated industry, his long-standing aversion is deeply instructive. The chronically poor customer service in the airline industry was not the cause of its problems. It was a symptom of a fundamentally broken business model. The industry was plagued by intense price competition, powerful labor unions, high fixed costs, and sensitivity to fuel prices. This brutal economic reality forced airlines into a constant state of cost-cutting. They saw customers not as assets to be nurtured, but as self-loading cargo to be transported as cheaply as possible. This led to a cascade of decisions that created customer misery: cramming more seats into planes, charging extra for bags, food, and basic comforts, and creating complex and punitive fee structures. The anger and frustration of airline passengers, the endless complaints about delays, cancellations, and poor service, was a direct reflection of a business model that had no room for customer satisfaction. For Buffett, this was a massive red flag. A business that is structurally incapable of making its customers happy is a business with no pricing power and no durable competitive advantage. It is a commodity business in the extreme, forced to compete solely on price, a game that almost always leads to poor returns for investors. The lesson from this decades-long avoidance is that widespread customer dissatisfaction is a sign that the business is at war with its own customers. And in the long run, the customers always win. A more specific and painful example for Berkshire Hathaway itself is the Wells Fargo account fraud scandal that erupted in 2016. For years, Berkshire was a major shareholder in Wells Fargo, a bank that Buffett had long admired for its efficiency and what he thought was a sound management culture. The scandal revealed that thousands of bank employees, under immense pressure to meet aggressive sales quotas, had secretly opened millions of unauthorized deposit and credit card accounts in their customers' names. This was a profound betrayal of customer trust, a systematic abuse orchestrated from the top down. The customer dissatisfaction, which had been bubbling under the surface in the form of complaints and lawsuits for years, was the canary in the coal mine. It was a clear signal that the bank's internal culture had shifted from one of service to one of predatory sales. The focus was no longer on the customer's financial well-being, but on hitting internal metrics at any cost. This cultural rot eventually led to a financial catastrophe for the bank. It faced billions of dollars in fines, a collapse in its stock price, and irreparable damage to its century-old reputation. Berkshire Hathaway, as a major shareholder, suffered significant losses. Wells Fargo scandal is a powerful, if painful, lesson that even the most astute investors can sometimes miss the signs. It underscores the critical importance of this pillar. Customer dissatisfaction is never just noise. It is a vital signal that the fundamental contract between a company and its customers has been broken, a leading indicator of a business in deep and dangerous decay. The tendency for companies to ignore the rising tide of customer anger until it's too late can be explained by a pair of dangerous psychological biases that thrive within large organizations: normalcy bias and the boiling frog syndrome. These biases create a blind spot for executives, preventing them from seeing the impending doom that is obvious to an outside observer. Normalcy biases are subconscious tendency to underestimate the possibility of a disaster and to assume that things will continue to operate in the way they have always operated. Inside a company with declining service, customer complaints become part of the daily routine. The call center is always overwhelmed. The online reviews are always negative. After a while, this state of affairs becomes normal. Managers and executives become desensitized to it. They see it not as an existential threat, but as a manageable, everyday operational challenge. They might create a task force to improve customer experience, but they lack the genuine urgency that the situation demands. They believe the company's brand is strong enough to withstand the discontent. The customers will complain but ultimately stay because they have no other choice. This was likely the mindset at Wells Fargo. The pressure to make the numbers was so intense and so long-standing that the ethical compromises required to do so became normalized within the culture. Opening a few fake accounts to save your job or get a bonus was no longer seen as a shocking betrayal, but as just part of the game. This normalization of deviance is a classic path to corporate disaster. This is compounded by the boiling frog syndrome. The analogy, though physiologically inaccurate for real frogs, is a powerful metaphor for our inability to react to slow, gradual threats. If you drop a frog in boiling water, it will jump out. But if you place it in lukewarm water and slowly heat it, it will not perceive the danger and will be cooked to death. Similarly, a company rarely decides to start providing terrible service overnight. Instead, it happens through 1,000 small cuts. A decision is made to reduce call center staffing by 10% to save money. A quality control step is eliminated to speed up production. A cheaper, less reliable component is used in a product. Each of these decisions, in isolation, seems minor and justifiable, but over years they accumulate, gradually degrading the customer experience until the company becomes a shell of its former self. Because the decline was so gradual, no single event triggers an alarm. The executives, like the frog, fail to recognize the danger of their slowly heating environment until it's too late and the water is boiling around them. For an investor conducting stock analysis, the key is to be the outside observer who is not subject to these internal biases. Your job is to touch the water and see if it's getting dangerously warm. By systematically tracking customer complaints and sentiment over time, you can detect the gradual increase in temperature that those inside the company have become numb to. This allows you to get out of the pot long before it boils. As an investor, you need a systematic way to detect these warning signs, a mental model for using customer complaints as a predictive signal for your stock analysis. This blueprint can be called the customer complaint signal analysis. It's a 4-step framework for turning the noise of customer anger into actionable intelligence. Step 1. Systematically track complaint trends. Don't just anecdotally read a few bad reviews. Be methodical. For any company you are analyzing, you need to establish a baseline of its customer sentiment. Use official databases like the Consumer Financial Protection Bureau, CFPB, for financial companies, or the Better Business Bureau, BBB, for others. Scrape data from review sites and social media, and track the volume and sentiment of complaints over time. Is the number of complaints per 1,000 customers increasing? Is the tone of the complaints becoming more severe? This quantitative approach to a qualitative problem is essential. You are looking for the trend, not the individual data point. Step 2. Look for systemic patterns. The next step is to categorize the complaints. Are they isolated incidents? A single rude employee, a lost package? Or are they about the same core issue over and over again? When you see hundreds of customers complaining about the exact same product defect, the exact same misleading billing practice, or the exact same impossible cancellation process, you have identified a systemic problem. This is not a random error. It is a feature of the company's operations, a result of a deliberate business decision or a deep-seated cultural flaw. This is a massive red flag. The Wells Fargo scandal would have been visible in this data long before it became a headline, as thousands of customers complained about accounts they didn't recognize. Step 3. Analyze the company's response. The nature of a company's response to complaints is as revealing as the complaints themselves. Are the responses automated, boilerplate apologies that solve nothing? Does the company engage in blame the customer tactics? Or are they genuinely trying to solve the root cause of the problem? Look for evidence that customer feedback is being used to drive real operational improvements. A company that ignores, dismisses, or fights with its complaining customers is a company that is fundamentally at war with its own market. This is a sign of a toxic culture that will inevitably lead to financial decline. A company that embraces complaints as a source of free consulting is one that is built to last. Step 4. Compare complaint data to direct competitors. No company is perfect. All businesses will have some level of customer complaints. The key is to understand the relative performance. How does the company you are analyzing stack up against its closest rivals? If its complaint volume is significantly higher or its sentiment scores are significantly lower than the industry average, it signals a serious competitive disadvantage. Customers in that industry have better alternatives, and they will eventually migrate to them. This comparative analysis provides the context you need to turn the raw data into a clear buy, sell, or avoid signal. By implementing this customer complaint signal analysis, you are effectively creating your own early warning system, a way to detect the canary in the coal mine and protect your portfolio from businesses that are on a path to self-destruction. This is a crucial defensive tool in the arsenal of any serious retail investor practicing long-term investing. The 99% of investors and managers often fall prey to a dangerous cognitive trap known as metric myopia. They become so focused on optimizing a few easily measurable internal metrics that they lose sight of the bigger picture, the actual customer experience. This is the path that leads directly to the kind of systemic dissatisfaction we've been discussing. Imagine the manager of a call center. Their performance and their bonus is judged on one key metric, average handle time, AHT, the average duration of a customer call. The corporate directive is to lower AHT. So the manager incentivizes their agents to get customers off the phone as quickly as possible. The agents, responding rationally to the incentives, start rushing through calls, providing incomplete answers, and sometimes even disconnecting the call to keep their times down. On the spreadsheet that goes to the executive team, the AHT metric looks fantastic. The manager gets a bonus for their efficiency. But what has actually happened? The customers are more frustrated than ever. They have to call back multiple times to resolve their issue, their problems are not being solved, and their perception of the company is plummeting. The company is hitting its internal target while systematically destroying its customer relationships. This is metric myopia in action. The manager is optimizing a proxy for success, call time, instead of actual success, a satisfied customer. The 99% of investors also suffer from this. They look at a company's financial reports and see rising margins or decreasing operating expenses. They might see that the company is reducing its customer service headcount and interpret this as a positive sign of operational efficiency. They applaud the company's cost discipline. They fail to connect these efficient decisions to the growing chorus of angry customers online. They are looking at the map, but they have no idea what is happening in the actual territory. They are analyzing the company's self-reported metrics without investigating the real-world consequences of the actions taken to achieve them. The path of the 99% is to trust the metrics that are presented to them. The path of the superior investor is to question them. It is to ask, what behavior did this metric incentivize? What is the unseen consequence of this improvement? Did cutting costs in this department create a much larger, hidden cost in the form of lost customer loyalty? To avoid metric myopia, you must be a skeptic. You must treat internal corporate metrics as just one data point, and often a misleading one. The true ground truth is not in the company's annual report, it is in the lived experience of its customers. The disastrous consequences of ignoring this are clear. By focusing on the wrong things, companies incentivize the very behaviors that alienate their customers, sowing the seeds of their own long-term failure and trapping the myopic investors who enabled them along the way. The financial connection between customer dissatisfaction and corporate decline is a direct and brutal one. A business that ignores the canary in the coal mine will eventually find its entire financial house collapsing. The bleed is quantifiable, and it happens across the income statement and the balance sheet. First, and most immediately, is the impact on revenue through customer churn. It is 5 to 25 times more expensive to acquire a new customer than it is to retain an existing one. A company with a high churn rate, driven by poor service, is on a treadmill of expensive customer acquisition. It must constantly pour money into sales and marketing just to stay in the same place. This creates a massive drag on profitability and makes sustainable growth nearly impossible. The revenue line might look stable for a while, but the underlying foundation is crumbling. Second, poor customer service directly inflates operating costs. The metric myopia example of the call center is perfect. While the company thought it was saving money by rushing customers, it was actually increasing costs. The need for customers to call back multiple times, the cost of handling escalated complaints, and the time spent on damage control all add up. Furthermore, product returns and warranty claims skyrocket when product quality declines, directly hitting the cost of goods sold. A dissatisfied customer base is an incredibly inefficient and expensive customer base to serve. Third, there is the massive and often catastrophic cost of regulatory and legal action. The Wells Fargo scandal resulted in billions of dollars in fines from regulators. Companies with deceptive practices or defective products face class action lawsuits that can cripple them financially. These are not just one-time expenses. They are a direct consequence of a culture that prioritized profits over people. The financial statements will eventually have to reflect the cost of this ethical failure. Finally, the most devastating financial impact is the erosion of brand equity and pricing power. A damaged reputation is a long-term liability that can take decades to repair, if ever. A company that is known for treating its customers poorly cannot command a premium price for its products. It is forced to compete on price, further squeezing its already thin margins. The value of its brand, its most important unseen asset, evaporates. This leads to a declining stock price and a permanently impaired ability to generate returns for shareholders. For a retail investor, this is the path to portfolio destruction. Investing in a company with a growing customer dissatisfaction problem is like buying a beautiful building with a rotting foundation. It may look good from the outside for a while, but a collapse is inevitable. The key to successful long-term investing is not just picking the winners, but also rigorously avoiding these predictable losers. The signal is there, in the voices of angry customers, for anyone who is willing to listen. This brings us to our fifth and final pillar, the very source from which a company's customer philosophy flows, the leadership. A company's culture is not an accident. It is a direct reflection of the values, priorities, and character of the person at the top. The CEO serves as the chief customer advocate or the chief obstacle to a customer-centric culture. This principle argues that the ultimate determinant of a company's long-term success with its customers is the genuine, deeply held belief of its leadership. There is no better example of this than Warren Buffett himself and his management of the diverse collection of businesses under the Berkshire Hathaway umbrella. Buffett's leadership style is famously hands-off. He buys wonderful businesses run by talented managers, and then, for the most part, he leaves them alone. However, he sets the cultural tone for the entire enterprise through his actions, and, most famously, through his annual letters to shareholders. In these letters, which are required reading for any serious investor, he repeatedly and forcefully articulates his core philosophy. He gives his managers only two primary directives. The first is to think like an owner. to manage the business as if it were the only asset they and their family would own for the next 100 years. This instruction immediately shifts the mindset from short-term quarterly profits to long-term value creation. The second, and more important for our discussion, is his famous dictum: "We can afford to lose money, even a lot of money, but we can't afford to lose reputation, even a shred of reputation." This single sentence is the cultural bedrock of Berkshire Hathaway. It communicates, with absolute clarity, what truly matters. It tells every CEO, from the leader of a massive insurance company like Geico to the manager of a local furniture store, that their primary job is not to maximize next quarter's earnings per share, but to protect and enhance the company's good name. This is not just empty rhetoric. Buffett's praise for his managers is almost always centered on this idea. For decades, he lauded Tony Nicely, the longtime CEO of Geico. His praise was not about Geico's stock performance, but about Nicely's relentless, fanatical obsession with two things: offering the lowest possible prices to customers and providing them with excellent service. By consistently delighting its customers, Geico grew from a niche player into a dominant force in the insurance industry, all while maintaining high profitability. Buffett understood that the low costs and high customer satisfaction were two sides of the same coin, creating a virtuous cycle that built an unassailable economic moat. He also demonstrates this principle through his own behavior. His personal frugality, his accessibility, and his candid communication style all set a powerful example. He treats his shareholders as partners, writing to them with a clarity and honesty that is a stark contrast to the jargon-filled, obfuscating language of most corporate communications. He is, in effect, providing excellent customer service to his own investors. By establishing this powerful, top-down cultural mandate, Buffett ensures that the businesses Berkshire owns are focused on the one thing that guarantees their long-term success: building an enduring bond of trust with their customers. He understands that a customer-centric culture is not created by posters on a wall or by a mission statement. It is created by the unwavering, demonstrated, and constantly communicated priorities of the leader. This is the ultimate lesson in executive decision-making. The CEO's primary role is to be the guardian of the company's reputation. The profound impact of a leader's focus on the customer is rooted in fundamental principles of human psychology, primarily social learning theory, and the authority bias. These cognitive forces explain how a CEO's personal values can cascade through a massive organization and shape the behavior of thousands of employees. Social learning theory, developed by psychologist Albert Bandura, posits that people learn from one another through observation, imitation, and modeling. In a corporate environment, the ultimate model is the CEO. Employees do not pay much attention to the official corporate value statement. They pay very close attention to what the CEO actually does. They observe who gets promoted, what achievements get celebrated at company meetings, and what kind of questions the CEO asks. If the CEO is constantly talking about the stock price and quarterly earnings, employees learn that these are the things that matter. They will align their behavior to maximize those metrics, even if it means cutting corners with customers. However, if the CEO, like Buffett, constantly talks about reputation and tells stories that celebrate employees who went above and beyond for a customer, a different lesson is learned. Employees see that customer advocacy is the path to recognition and advancement. They will imitate this behavior, and a customer-centric culture will begin to take root organically. The leader's actions become the blueprint for the entire organization's social learning. This is powerfully amplified by the authority bias, our innate tendency to attribute greater accuracy and importance to the opinion of an authority figure. A CEO's words carry immense weight. When Buffett says, "Lose money and I will be understanding, lose a shred of reputation and I will be ruthless," it is not just a suggestion. It is a command that shapes the decision-making framework of every manager in the Berkshire ecosystem. This bias means that a leader's priorities are not just followed, but are often internalized by their subordinates. If the leader is genuinely obsessed with the customer experience, that obsession becomes contagious. It defines the terms of success for the entire organization. The Wells Fargo scandal serves as the perfect negative example of these principles. The authority figure, then CEO John Stumpf, relentlessly pushed a culture of cross-selling, famously aiming for 8 is great, meaning 8 Wells Fargo products per customer. This was the behavior that was modeled and rewarded from the very top. Employees learned, through social learning, that the path to success was to open more accounts, regardless of the ethical implications. The authority bias ensured that this dangerous priority was adopted throughout the organization, overriding the individual ethical judgment of many employees. The lesson for investors is profound. When analyzing a company, you are not just analyzing a business, you are analyzing the psychological impact of its leader. The character and priorities of the CEO are the single most important leading indicator of the company's future culture, which in turn determines its long-term relationship with its customers and its ultimate financial success. To effectively analyze this critical leadership component, you need a mental model, a systematic approach to evaluating a CEO's true commitment to the customer. This can be called the leadership litmus test, a 4-part blueprint for looking past the corporate spin and understanding the person at the helm. Step 1. Perform a shareholder letter autopsy. Go back and read the last 10 years of the CEO's annual letters to shareholders. This is the one document where the CEO speaks in their own voice directly to the company's owners. Perform a qualitative and quantitative analysis. Quantitatively, search for keywords. How many times are customer, reputation, and trust mentioned versus terms like synergies, financial engineering, and share repurchases? Qualitatively, analyze the tone. Is the language about customers genuine and filled with specific examples, or is it generic corporate jargon? A CEO who consistently and passionately articulates a customer-first philosophy is likely to be leading a company that reflects those values. A CEO whose letters are a sterile recitation of financial results is signaling a different set of priorities. Step 2. Investigate the incentive structures. This is where the rubber meets the road. A CEO's words are meaningless if the company's compensation system rewards the opposite behavior. Dig into the company's proxy statement and other filings to understand how executives and employees are paid. Are bonuses tied to customer satisfaction metrics like Net Promoter Score (NPS), or are they based purely on short-term sales quotas and profitability targets? The incentive structure is the most honest expression of a company's true priorities. The Wells Fargo scandal was a direct result of an incentive system that rewarded employees for opening accounts, not for serving customers. A company that aligns its financial incentives with customer happiness is a company that is serious about its commitment. Step 3. Analyze the CEO's background and public persona. Where did the CEO come from? Did they rise through the ranks in product development, marketing, or operations, roles that are naturally closer to the customer? Or did they come from a finance, legal, or administrative background? While not a perfect indicator, a CEO with a deep operational history is often more attuned to the realities of the customer experience. Also, observe how the CEO behaves in public. Do they spend time in their stores or with frontline employees? Do they respond to customer complaints personally on social media? Or are they insulated in the executive suite, interacting only with bankers and analysts? Look for evidence of a leader who is grounded in the reality of their business. Step 4. Evaluate their response to public criticism. Nothing reveals a leader's true character like a crisis. When the company is publicly criticized for a product failure or a service issue, how does the CEO react? Do they take immediate ownership, apologize sincerely, and transparently outline the steps they are taking to fix the problem? Or do they become defensive, issue hollow non-apologies, and try to shift blame? A leader who is genuinely committed to their customers sees criticism not as an attack, but as a gift of valuable feedback. Their response to adversity is the ultimate litmus test of their customer centricity. By conducting this 4-part test, you can develop a much more accurate and nuanced picture of a company's leadership and culture, a critical piece of qualitative analysis that is essential for any successful long-term portfolio growth strategy. The path of the 99% of investors and executives is to embrace the archetype of the detached executive. This is the leader who resides in the proverbial ivory tower, completely insulated from the daily realities of their customers and frontline employees. Their world is one of spreadsheets, board meetings, and calls with Wall Street analysts. They manage the business by remote control, making decisions based on abstract data that has been filtered through layers of middle management. The detached executive believes their primary job is to manage the company's stock price. Their calendar is dictated by the quarterly earnings cycle. Their decisions are optimized to beat the street's expectations for the next 90 days. They are playing a short-term game, and the customer is often just a pawn in that game. Because they are so disconnected from the customer experience, they are highly susceptible to the metric myopia we discussed earlier. They see a report that says call handle times are down, and they celebrate it as an efficiency gain, completely oblivious to the customer rage it is creating. They approve a decision to switch to a cheaper raw material to boost gross margins, without understanding the devastating impact it will have on product quality and brand reputation. The 99th% of investors enable this behavior. They reward the detached executive for hitting their quarterly numbers, pushing the stock price up in the short term. They rarely ask the hard questions about customer satisfaction trends or employee morale. They are complicit in the destruction of long-term value in exchange for a short-term pop. This leadership style inevitably creates a culture of indifference. If the CEO is detached, that detachment cascades through the organization. Managers learn that the way to get ahead is to produce good-looking reports, not to create happy customers. Employees learn that the company doesn't really care about the customer experience, so why should they? The result is a slow, creeping decay in service and quality, a gradual erosion of the company's soul. The detached executive is often a brilliant financial mind or a master strategist, but they lack the one essential ingredient for building an enduring business: empathy. They cannot put themselves in the shoes of their customers or their employees. They see the business as a machine to be optimized, not as a human ecosystem to be nurtured. This is the antithesis of the Warren Buffett approach. Buffett and the managers he admires are deeply engaged with the reality of their businesses. They are obsessed with the details of the customer experience because they know that is the source of all long-term value. The detached executive is the most dangerous person to have at the helm of a company you own. They are the captain who is navigating by looking only at the ship's financial gauges, completely unaware of the iceberg dead ahead. The financial connection between customer-centric leadership and a company's performance is the ultimate virtuous cycle in business. A culture that starts at the top and is relentlessly focused on the customer creates a powerful, self-reinforcing engine of profitability and growth. First, a customer-centric culture, driven by the CEO, becomes a talent magnet. The most skilled and motivated employees do not just want a paycheck. They want to be part of an organization that has a positive purpose and that they can be proud of. A company with a reputation for delighting its customers will attract the best talent in its industry. This lowers recruitment costs and, more importantly, reduces employee turnover. Low turnover is a massive, though often hidden, financial benefit. It dramatically reduces the costs of hiring and training new staff and retains valuable institutional knowledge within the company. Happy, engaged long-term employees are also far more productive and innovative. Second, this virtuous cycle directly enhances the customer experience. Happy employees provide better service. An engaged engineer will build a better product. A motivated salesperson will focus on finding the right solution for the customer, not just on hitting a quota. This superior service creates more loyal and satisfied customers. These customers then buy more often, and are less price-sensitive, which drives revenue and gross margins higher. They also act as brand evangelists, further reducing customer acquisition costs. Third, this entire cycle leads to sustainable, long-term portfolio growth for the investor. The combination of lower operating costs from reduced employee turnover and marketing expenses, and higher, more stable revenue from a loyal customer base, creates a business with exceptional and expanding profit margins. Because this growth is organic and built on a solid cultural foundation, It is far more durable and predictable than growth achieved through financial engineering or risky acquisitions. This is the holy grail for the value investing practitioner, a business that can compound its intrinsic value year after year with minimal additional capital. When you invest in a company led by a true chief customer advocate, you are not just buying a collection of assets. You are buying a piece of a powerful, self-sustaining financial ecosystem. You are aligning your capital with a business that has figured out the ultimate secret to success. The business of business is not about making money. It is about creating and keeping a customer. The money is simply the byproduct of doing that exceptionally well. The leadership's role is to never let the organization forget it. You have just spent this time acquiring a powerful new lens, a mental model that will fundamentally change the way you look at any business. You now understand that the seemingly soft metric of customer satisfaction is, in fact, one of the hardest and most predictive signals of a company's long-term financial success. You can now see the economic moat of fanaticism, recognize the unseen asset of trust on a balance sheet, appreciate the compounding power of reputation, detect the warning signs of customer dissatisfaction, and understand that it all starts with the leader in the chief executive's chair. You have moved beyond the spreadsheet and learned to analyze a company's character, its very soul. This tool will allow you to sidestep the predictable failures that trap so many investors and to identify the durable, compounding machines that build generational wealth. But mastering this principle is just the first crucial step in building a complete intellectual arsenal. Warren Buffett's system is not a collection of isolated tricks. It is a deeply interconnected network of mental models. You've just forged a key, but it only opens one of several locks. You've learned how to identify a wonderful business, a business with a formidable competitive advantage. But this knowledge is incomplete without its counterpart. At what price does that wonderful business become a wonderful investment? How do you avoid the fatal trap of overpaying, even for the best company in the world? How do you connect the qualitative strength you can now see with the cold, hard mathematics of valuation? The video that is now appearing on your screen is the missing link. It is the next piece of the map. It takes the principle of identifying the world's greatest businesses and fuses it with the discipline of buying them only when the price makes sense. It bridges the gap between analyzing a company's story and analyzing its stock chart. The journey of an average investor ends here, with the acquisition of a single interesting idea. But the journey of those who are truly serious about their financial future, those who seek to build not just a portfolio but a fortress of financial freedom, that journey continues. The choice to click is not about watching another video. It is a decision about who you want to become. It is a commitment to continue your ascent, to complete your mental toolkit, and to master the entire system. The next step in that transformation is right there in front of you.